Welcome to the Pump and Dump channel for an emergency or special update looking at the stock market. It's now Thursday morning my time, but I think this Wednesday, the 11th of March trading day, gave a clear signal as to the direction of where we are going. I saw enough to be convinced that there is a real possibility of a stock market meltdown, something beyond what people have experienced in recent past since 2008, 2009. There is not much really that's there to support the stock market from collapsing. Of course, on the technicals, we kind of closed at the 200-day moving average from the all-time high coming down to the 200-day moving average. We held it previously here and here, I guess you could say, but there's no reason to say that we can't go through like here. So officially it was announced that we're in a bear market. Bear market is not good for the general market as a whole, but in terms of individual industries, some can actually outperform. Whether that means losing less or actually making a real rate of return is up to debate. But getting into some of the news, World Health Organization declares coronavirus outbreak a global pandemic, basically suggesting that now we need to shut down travel, put in restrictions for people traveling here and there. The problem is, of course, this virus has been spreading for months and it's most likely already everywhere, so restricting travel at this point in time is not going to do anything to really help stop it spreading. In terms of death rates, I'm not really familiar with it, but some people say 2% of the patients die, and they're mostly elderly. If we look at what factor the elderly people play in our society, of course, usually the elderly people are those in a political office who have some decision-making power, and if they feel under threat, they'll do everything to protect themselves to, avoid dying from a virus that can harm them more than it can harm younger people. And also looking at older people, they are, from a financial standpoint, socioeconomic standpoint, they are the spending power, because they get pensions for doing nothing. They are not working for the money they receive, and due to the fact that most let's say low skill or average working class person who works in, whether it's a supermarket or as a butcher, considered low skill, these people get paid very little, so their income does not justify the production that we have for everyone. If we lose all these pensioners who have all this money to spend on things they need like healthcare and food, then without them a lot of jobs are not needed anymore, and a lot of production goes away, and people who are already on low income, they don't get the compensation from their employment to make up for that loss in demand in real terms. So getting to the charts for the Dow Jones, we have, I don't know why I have this red line here, but whatever. Let's just do this, see if that does anything. Okay, that absolutely failed. Let's try again. Okay, that's better now. So we have this long-term chart, this trend line from the 2016 and 2018. We pierced through it on Monday, and Tuesday we came back above it. Wednesday we went strong through it again. Previously we had this trend line here that was no resistance on the way down, but served, or no support on the way down, but served as resistance on the bounce back. And now we are currently here. We were initially green. I was recording the video when we were green, and then I got interrupted, and then I had to start over again. But going back to the video I made not so long ago, the real problem here is that it's unfolding exactly like I was fearing it might. Of course, we peaked out on the 19th of February on the indices, the S&P and the Dow. For the oil price, it was on the 8th of January, and the Dow has been and the S&P have been following the same chart pattern as the oil price, and the news flow pattern is also consistent. So on the 29th, I of course took my initial screenshot here from my video there, and I laid out that I thought we'd have a dead cat bounce here, a bear flag, and then we'd continue going down, and that's unfortunately exactly what happened here. In terms of magnitude, the move down here, 25,000, is kind of where we got down here, and then we rebounded to 27, and then we created to 23, and this big move down. In terms of the oil price charts, it's exactly the same down here, bear flag here. This big red candlestick here would be for the 9th of March, where we went down 2,000 points on the Dow. Of course, we started this whole thing with minus 1,000, and then we had several 1,000 days up and 1,000 points days down, and now we've gone up to 2,000, and it just seems like it's the magnitude of these moves is just going to continue. So one difference here, divergence between these two charts for the oil and the oil price and the Dow Jones, is that on Tuesday we had this relief rally here on hope of bailouts leading to a reversal in the Dow Jones and in the other indices. Of course, we also had previously a rate cut up here, and that didn't work, so why would announcement of bailouts here help? Just suggests that companies are in dire straits and people are starting to run for the hill, because once a company goes into a state of evident bankruptcy, what happens is the share prices decline very, very rapidly. It's like, you know, as long as they can survive in a few quarters, hoping for the markets to turn with a massive rebound in whatever they're selling in terms of the price going sky high, you know, they have no chance. So what usually happens is towards the end they collapse into bankruptcy, the share prices collapse very rapidly, and this is kind of what this decline is starting to suggest is going to happen. So combining the 10th and the 11th, this green candlestick here and this red one here, if we look at it, the down move on Wednesday was bigger than the rally on Tuesday. It kind of encompasses it. If we take this green and this red and we offset these two bodies here, then we remain with a small red candlestick down here with just a line going up here. So that we could say, if we combine that, we could say this here, the 11th would be this little move down, 11th and 10th, and that suggests for Thursday the 12th we have another very big move down coming, probably 1,500 points or so, and that would lead us into Friday. So Thursday I would say, you know, we're coming from 23,500, we could drop maybe 2,000 points even to 21,700. And then Friday the 13th we would see probably, of course looking by the chart here, we see that this gap down, probably I think it was a gap down, certainly looks like it. What we would see is, you know, we'd be down here Thursday, and then there would be panic about, will this 2018 low hold? I saw there was a Christine Lagarde's picture on one of these news articles saying that, you know, she's calling for desperate measures. Something needs to be done. Someone needs to do something. And if nobody does anything that solves this problem, and I don't think it really can be solved, what we're looking at is a gap down from 21,800 to maybe like 20,000, and then just a precipitous decline to 18,000. So that would be like a 3,000 point move on Friday the 13th. So I'll just mark this out as a 3,000 point decline. And in terms of looking at this chart here, what it suggests is, you know, we're going to keep falling to 21 for Thursday the 12th. Even though it's like 21.7, it's no difference, and then we drop to 18,000, which would be around here. And then people will panic. They see the gap down and a really bad day. The momentum traders will see this as an opportunity for another bear flag. You know, a 50% retracement on Fibonacci, whatever. Let's say back to 20,000. And then we just continue falling to 15,000. 15,000 represents the low here of 2016 before we started rallying up. If we look in terms of the oil price, that suggests, you know, like around the $49 oil price. Of course, we came from 65, and on the Dow we're coming from 30k, and you'd say like, well, that's only like 50% move down here, whereas here it's only like a 30% move. So why the difference in percentages? Of course, the equities are leveraged. You have some players that look like this and some players that look like this in terms of equity to debt. And when markets decline like they have, like in the oil price, oil companies, they move, well, good companies, they move from this to that. And that leads to an erosion of equity, which of course the Dow Industrial Average represents the equity portion. And when that's eroding, you get these massive declines here. And the problem is that, you know, from this 49 level, we did rebound up to like 54. And that would like be, you know, going back to the 18,000 on the Dow level. And then, of course, with the oil price, we fell to 44, 43, which you could then say would be like a drop to 11,000 on the Dow, followed by a rebound to 49. You can show here the oil price, 54 to 40, 44 to 59, and then continuation down to 27. So rebound to 15, and then down to 27. And that would take us into single digits, maybe 8,000 on the Dow, maybe 6 to 8,000. An 80% decline in the Dow Jones Industrial Average, and that is what it is looking like is happening right now. And it's very, very sad, because lots of people are tied up in their 401k, and the news with these emergency rate cuts and bailouts and central bank calling for action, that something needs to be done, that make people think that, you know, scared to go short, and, you know, hopeful that if they stay long that things will work out for them. We're falling down the waterfall of hope, and this concept is incredibly important, the waterfall of hope, because looking at the oil price, it was exactly the same when we peaked out. It was a fear of a war with Iran, and then that faded. Apparently, you know, 3 soldiers were killed when the Iranians launched missiles at the US base in Iraq, and Trump then said no one was seriously injured, so there was no war. That was called off. Then it kept falling, then OPEC came into play. OPEC will cut, and that will stabilize the price, and the hopes were for OPEC, and that OPEC turned into nothing in the end, because Russia and Saudis, and they are flooding the market now, apparently, to bankrupt the US shale oil producers, the Permian producers, who are in a very precarious situation. They're very vulnerable. And this is kind of what we're seeing here, the falling down the waterfall of hope. It just keeps dropping. I mean, now we're almost down a percentage point. On the Dow we were up, I think, 0.5% or so at the beginning of the day, but now it's just turning red, and it's just there's no hope in sight that this is going to actually, you know, go up again at this point in time, in my opinion at least. So this is the reality, is that we're facing a massive decline. Target, of course, of single digits on the Dow might seem incredible now, but if we look in terms of the oil price, it took only 2 months from the 8th of January to the 9th of March to go from 65 to 27, a 60% decline. And in terms of the Dow Jones, we're looking at April 20th, where we could see a $6,000 to $8,000, not dollar but points, Dow Jones, if this continues. And there is a lot of evidence to suggest that this can happen because the fundamentals are very weak. Too many over-leveraged companies who, in the good times, like oil companies when prices were stable, when they were like this, and they were performing with the oil price like this, they decided to, issue some debt and then buy back their shares, because obviously this simpleton thinking of shares yield 6% and the debt only costs 2%, so it's accretive to shareholders to borrow money and to buy the shares. And then they transition to this, and when you're like this, you kind of move like this with the oil price. And the big difference between these two fundamental stances is that in a bust where you go from 65 to the current $33 oil, you see companies like this, their balance sheets, they evolve into looking like this. And what that does with the equity part is it takes it down, but then it stabilizes as long as they are solvent and they can survive lower oil prices. But once you transition to something like this, through financial engineering with debt for equity, you put yourself into a situation where if you go down to $30 oil, your share price goes like this, and it doesn't do this wiggling, because at this point here it's beyond zero, worth zero, and then it becomes a question of how long can they survive living off their current assets, liquidating their cash and liquidating any financial assets they hold on their balance sheet to survive, to hopefully when the oil price recovers to come back above zero and then have a positive valuation. That's kind of what they're hoping for when they're down here. But if the oil price stays in this range too long, they bleed out their cash and they go bankrupt and they have no chance. So yeah, that's kind of where it's at. I think even though I don't give recommendations or advice to anyone on my videos, I will say that buying now is not the time to try and be a hero and thinking you're buying the low. It's absolutely not a time to be a hero. You want to definitely be conservative and just maintain sufficient liquidity for living expenses, and even consider buying essentials that you need in case people who are running to the store and picking up all the toilet paper, and the news is saying it's because of the coronavirus. Maybe they are not doing it because of that. Maybe they are also concerned about this and they can feel it. They see the job losses in certain sectors, and they just know that something similar to 2008 is coming, and if you were not prepared in that period of time after you experience it, you will certainly be prepared for the next time it happens. So buying now is a really, I wouldn't say silly thing. I mean, if you're starting to invest, then of course you need to make sure that you know what you're investing in first and foremost. But if you're just putting into an index fund, taking the market rate return, this is the market rate of return, from 30 to sub 10. You don't want that kind of return if you don't have to take it. And yeah, making contributions to 401ks at this point in time, I would not, taking money out is of course everyone's decision, but I would not be contributing at this point in time. I would be building cash, and if it does go up, then okay, you missed some opportunity to have a little more later on. But if I am right and you are not contributing, you're keeping the liquidity in your pocket, if you then see a precipitous decline and a collapse like this that leads to lots of bankruptcies and job losses, you'll be okay. You won't have to sell your financial assets at the low if you still hold them. And you'll be able to, if you have a lots of liquidity just lying there, you even at the low, you have a chance to make some decisions as to what to buy and what not to buy. So yeah, um, in a situation where the Dow goes like this, you have bankruptcies of weak companies, job losses at them, of course, but also at good companies. If you're working for a stable company and you're not essential to that company, then you are also at risk, because if they lose their clients who go bankrupt, then they won't be, they won't be able to pay you, and they won't need you. So, well, they will be able to pay you, but they'll say they don't need you, and then they'll just lay you off. They'll say, we'll call you back when business is back to normal, and then they just tell you to live off your unemployment benefits or off your reserves if you don't have that, and depending on which country you're in. In this situation, you really want to be in cash, and you want to be safe. You don't want to go for glory when the risk is just too high. And I think the risk at this point in time is just beyond high. So yeah, the waterfall of hope. What have we seen so far? Rate cuts didn't work. Bailouts didn't work. Next step, bankruptcies. I saw somewhere or read somewhere, I can't remember, that the Trump administration is considering guaranteeing loans. That's again hope that this will stabilize the system as a whole, but it won't. If you look back just to what happened with Thomas Cook in, I think it was in August last year, 2019, when they went bankrupt. What happened there was they didn't get any emergency assistance because their assets were not sufficient to cover their liabilities. So why lend them money whilst they have no value to to lend against? And outside of that situation of them going bankrupt, you had Condor, I think, which was like a sister company of Thomas Cook. They were solvent. They had good assets. They got emergency bailout from, I think, the British government or German. I can't remember. Someone gave them money for sure. And basically, once you start seeing bankruptcies, that is kind of when there will be calls for actions. But at first, the weak ones will just fail. The economy will contract, job losses will mount, people will be unemployed, and eventually what will have to come out of it at some point in time is the companies who survive will do mergers and acquisitions. Some weaker companies with lots of upside will merge into stronger companies at maybe unfavorable conditions, but maybe at favorable conditions, who really knows? And other companies will just be outright acquired. And the acquisition cycle then, of course, will require those companies who do survive to spend money. Now, one thing that, of course, happens during this bust is that the amount of dollars in the system relative to the debt, or the currencies to the debt, it will increase as the debt, the liabilities decrease, as weak companies who have almost no current assets or anything of any value, as as they go down, the amount of debt goes down, and the cash relative to the debt as a factor, as a ratio, will go up, because the underlying assumption of a financial system like we have it with assets and liabilities is that the assets are equal to the liabilities. But when you see liabilities being wiped out because some players can't pay them off, what you see is that the other players in the game, in the economy, in the system, whatever you want to call it, they will be in a situation where they have cash, and they won't have so many liabilities, and then you have a situation of imbalance where there's more cash than liabilities in the system, and that ultimately should lead to inflation longer term, because if you can repay all the debt, then you don't need the banks, and then you have a free economy with a currency that's is moving within the economy between different actors, and that is unfavorable for the banking system. So when we see these mergers and acquisitions that are supposed to happen, or let's say they need to do some capital expenditure to improve their efficiency, or they need to spend money to train people, or they need to in any case they need to spend money, and they'll look of course at leveraging themselves up, and the banks will be happy to loan them money. So let's just highlight here that out of this bankruptcy, inflation, monetary inflation in the system will start rising, but it won't manifest yet because people who just lost their jobs will be strapped for cash, and they won't have much cash to spend, and the prices that companies will receive for the products they make will be very low. The prices will be too low for them to justify you know, expanding production. But at one point in time, you know, they'll be told or they'll conclude that the prices have to go up, and then you will have, let's say at point Y, you'll have QE. And most people know or believe that QE causes inflation, and that's why we had this massive run up in equities because of QE, nothing else. And QE in the short term, it drives inflation up. But as we see now, going into the 11th year of this liquidity-driven bull market, long term it drives inflation. It brings it back into balance, and at some point when it's like a vector that goes in one direction, and when you get to the breaking point where you're back in balance, the deflationary force of quantitative easing, being interest-bearing debt, whether it's 1% or 6%, really doesn't matter in the long term. The deflationary force of this interest on the debt, where they want more money back than they loan into the economy, leads to a reversal, and that is the bust we are, in my opinion, experiencing right now. So the next cycle will of course be associated with QE again, in which form we don't know. And then it will just be like, it'll be the boom and bust economy that we have had for so long. And I know a lot of people have, in the last 2 years, they have gotten interested in investing because they see the stock market just keeps going up and up and up, and they feel like they want to take part in it, and they want to join in. And one way to look at it, of course, is that retail investors always lose, and the Wall Street banks, they always win. 2009, so many people were destroyed and were afraid to put money into the market. That led to some absence, let's say, of retail investors, and the Wall Street and banks, they had to just they had to do what they had to do to price in a rate of return for themselves, a positive rate of return. From 2009, they just kept raising prices. It's kind of like at the supermarket. If you go there and you want to buy milk, and they're not managing to sell it one day, they'll just raise the price the next day to make up for the the rate of return that they expected and didn't get. And when of course it doesn't happen day to day, that goes like over a longer period of time. But like if I go to the supermarket, I remember that a liter of chocolate milk used to cost €1.92 last year, and now it's €2.08. So maybe they didn't sell a lot of chocolate milk and they wanted to get their money back, so they just raised the price. And this is what you have in these bull markets, where retail investors are skeptical and don't want to participate. You have these banks and hedge funds and investment managers and so on and so forth. They just keep marking up, and then they ask the central bank from time to time to do some QE program to keep this thing going, until they can dump all their stock or a lot of it onto the retail investor and then destroy the retail investor. That's kind of the name of the game, and this is unfortunately where we are at. So yeah, going to take some time. Um, QE will be the confirmation that we have bottomed out. Bankruptcies, mergers and acquisitions will be a sign of bottoming. It's very important to understand that, you know, it's not always as they say in the financial news media. Like the repo operations, they say it's QE. Well, the QE is going where? It's going into the bond market. It's not going into the stock market. Why is it going into the bond market? Well, who really knows? But one thing for sure, banks who have bonds and equities on their book, if their equities are declining, they need the interest rate down to mark up those bonds. That's what happened in the the European Union with the central bank coming up with these ideas of negative interest rates for depositing money at the central bank, so that the banks go out and overpay for bonds and they buy every bond and mark them up to market, being at a premium to what they will generate over their holding period, which is of course, you know, long term it's a losing, a guaranteed loss, but these banks, they just keep buying it because it keeps the illusion of solvency on their books. So yeah, buying now is not the time, in my opinion. No time to be a hero. It's more prudent to, you know, build cash and hold out and wait and see where this thing goes. As the cycle, of course, concludes with bankruptcies and layoffs being in the news all over the place, looking to the stronger players in the industries that you know, and then deploying money into those ones when you can get them at a discount to the fair value. And then just holding them, waiting for the QE to come in, and depending on how big the QE is, you'll know what the bull market will look like. And there are, of course, other factors to consider. Everyone, of course, wants to see the stock market do this, then buy at some point, and then see a miraculous move back up here, like a 10 bagger or a 5 bagger. But there are some factors, of course, that are very important to consider in this scenario that we are in. We have come out of a 2009 bust, and we had interest rate lowered to record low levels, zero interest rates, basically as a policy. And with 0% interest rates, the market went back up as QE came in and, you know, helped push money into the system to get prices back up, and therefore equities reflected that. And depending on how this whole thing pans out, it really depends. I mean, in my opinion, people have been unhappy with low interest rates on savings, bonds and stuff like that. In savings accounts, they're unhappy about that, and that's why people have gone into the stock market, because they can get you know, a good yield there if they're right on what they buy and if the market is performing well. But if we come out of this bust and people complain that because of the 0% interest rate by the policy by the central banks, causing them to have to go into equities and losing tons of money, especially like I mean, if you're like 50 years old and, you know, you've saved up 400,000 in your 401k, and you see an 80% decline, where you go down to, like, I don't know, like to 60 to 80,000 in terms of your net worth. Or even if you're like 55 years old and you're at 400,000, it's even worse, because you have no chance to recover from this. You're just in dire straits. You're just finished. There's no way out. You know, you won't be able to retire at 65 with a million or $750,000 to your name and a paid off house. You'll be like told, you know, you're gonna have to work until you're 65 or 70, like they did in 2009 when people had been destroyed in the stock market. I mean, if you're like 20 and you have like a little bit of money in here, like you're 25, let's say, and you have 20,000 in, and you lose 90%, and you just keep, you know, averaging or buying good investments over the long term, you could still come out okay before you retire. But if you're too long in the tooth, too far along the way, you're already old, and you have a market crash like this, you're finished. you'll be facing suicide as a potential scenario of why what happens out of these kind of busts. It's kind of sad. But getting back to the outlook, if we see interest rates, let's just use 5% interest rates. If we see interest rates going to 5%, a lot of companies who will be, who will look like this at the low with a lot of debt and little equity, they will probably be facing, high interest rate costs for borrowing to, do what they need to do, expand or fill short-term a gap, or to refinance a bond. Once you're on a 5% interest rate environment, it kind of means that stocks that have been going down like this, they might recover, but they might recover very slowly, and it might, like if I'm getting these numbers right, like we go from 30,000 down to 6,000 in the worst case scenario to 2009 levels, that would be we're down 80%. And if we have rising interest rates at the same time, a lot of these stocks, a lot of these companies from the low, they might only make back like 50% from the low. So basically on a net you'll be minus 70% with no chance to recover. And the big problem will be that when these companies are in dire straits, what will happen is, of course, the Wall Street people, they will look at these companies and say, yep, this is a good investment, let's go to them and ask them to raise cash with us, and we'll buy some equity. And what happens is you are diluted, and instead of being able to rebound and getting to just a 70% loss over a couple of years later after the bust, you might still be down 77%, and you might only get like 3% back because of dilution. So this is kind of the bad companies. They will end like this for sure. The good companies will most likely be, if they go down minus 80%, they'll rebound from the low by plus, let's say, 400%, which will still mean that you net down 20%, but being down 20 net is better than being down 70 or 80%. And of course, if you do manage to dollar cost average into something good, like a good company that can survive at low prices, what you will get is this this boost that takes you up and beyond what your losses would have been. So if you average down here, if you just add like 20% to your position at the low, you can break even or even come out ahead if you got in at the high. So that's something to think about. Of course, I don't give investment advice or recommendations on my channel, but in terms of life advice, of course, I'm like in my mid-30s, but I will say from what I've heard from other people, in 2009, there was some people who I worked with. They told me that it was like in 2015 when I talked to them about 2009, the crash, because they were a bit older, and they told me in 2009 they sold everything because they were so afraid and uncertain, and some of them had money worries. They just thought they were in the worst possible scenario, and they had to sell because they didn't know whether they would be able to get a job or whether they would be able to eat if they didn't sell now at that point in time. So you want to avoid that for sure. So I think at this point in time, I think I'll give everyone who's listened, I know there's only like 5 or 6 people who really look at my videos. I don't even know if I looked to the end, but I'll give a plan for this at this point in time. Number 1 is build cash. Number 2 is stock up on goods. essentials, toilet paper, like you see in the news that people are rushing to the store buying toilet paper and stuff like that. Um, Frozen food, canned food, etc. I think it's a very prudent thing to do is to stock up on essential goods because the news is saying that they're doing it because of the coronavirus, but there is beyond the coronavirus panic that's being linked to this whole thing. There are other drivers in the economic system that are making people worried. It's not just the virus; there's also the stock market is collapsing, the economy is failing. A lot of companies are looking like they're in dire straits. I looked at AT&T and General Electric, their balance sheets, and they have like 100, 200 billion in debts, and they're not making any profits on. Well, they were not making any profit on GE side for sure when I was looking at them, and they're kind of in a situation like if you see a GE or an AT&T go bankrupt, you need to imagine that these are big cap companies who have huge market caps and lots of employees. They go bankrupt and they lay off all those people they have employed with them. There's going to be so many people out of work that all the industries that are related to them will be affected. Like I talked about, even if you're in a good company and your client goes bankrupt or goes out of business and is in trouble or lays off lots of people and shrinks, it affects every business around them. It's the domino effect. So stocking up on goods that's food, essentials, and cash. Go to the bank, get yourself a few thousand out, 2,000, 3,000, whatever you need. You want to avoid a situation like you had in Greece, where people, or Cyprus, where they couldn't get their money. They got told that they can only have like 200 or 300 euros a day or a week or something crazy like that out of their account. So those are things to do. Number 3 is if you're an investor, have your watch list. Look at valuations of companies, how low they can go. Always look at the intrinsic value for a working business that is very stable. I would say like for stable business, you want to look at least a 50% discount to the net present value, up to 75%. Only buy on these thresholds. Of course, you don't want to buy something like I don't know, like an industry where prices are really high, sky high. I mean, if you're looking at a Rio Tinto or BHP Billiton, let's have a look what the iron ore price is. Just look off screen. $88 a ton. You don't want to buy these kind of companies. Let's see what the share price is. There we go. So, okay, that's in Australian money. Of course, it's completely folding. Rio Tinto, it's been going down since January 22nd. It's just been rolling over. It's down like 30% or so. So you don't want to be in something like that because iron ore price in 2014 fell to $30 a ton. And you want to avoid that definitely, because if you do have an economic slowdown or recession, iron ore price is going to crumble, copper price is going to crumble. I have, of course, the oil price here. I think energy, it does look like it went down to 27. 2016, I do think we get a significant bounce from here, maybe to 37, 38. Energy is below the cost of production, especially WTI, for a lot of oil producers in the United States, the growth prospects are being slashed, the capex is being slashed. Uh, Companies like Diamondback and Chevron and other ones are talking about, you know, not going with what they initially planned. Of course, they're going to cut dividends if they pay them. I think Pioneer pays a dividend. They're going to cut it for sure, even though it's not very much. So you want to look at stable businesses, and obviously you would like to look in industry where the cost of production is, kind of below the average of what companies can produce it at. So energy like oil and natural gas for sure are a sector to be looking at now. Of course, they're going down with the general market. Unfortunately, there's nothing you can do about that. Then looking at industrial metals, I have copper here on the screen. I have, of course, my trend line here, triangle formed here. Of course, you can also see there's a triangle here where we broke out of and went up. And then we kind of collapsed here. And I talked about this previously, how the copper miners like Turquoise Hill and Lundin Mining were not going down with the copper price, and I said they would follow. And of course, I mean, the whole market's going down, so obviously they're going down too. And the copper price did have a bounce here, and those stocks, they were, they had, they started selling off after this bounce here, really. And you can see the copper price here is in this widening wedge. I've seen these patterns in like some instructional videos or books. Usually they say that widening wedge is very, I don't know, like it's very difficult to know what will happen, but it can just like shoot up to the upside at one point, but usually it will go, along one of these trend lines, and it's looking really bad. If we go back to 2016 levels, we're at below $2 on copper. I've looked at some of the production costs of mining companies. A lot of them, they like to just represent themselves as being low-cost copper producers, and they'll say they can produce it for $1.60, and then you look at the details, and then they're talking about net of I don't know, byproducts like gold, and gold is of course very high. Well, not really at the all-time high, but it is relatively high historically speaking. So that kind of like, makes their production costs seem a lot less than it really is under normal circumstances. And then, they're always talking about the cash cost. Usually, they're not talking about the all-in sustaining cost has also become like a main metric that investors look at. But when you're looking at a business, you don't just look at the operational cost. You also have to look at the cost of capital and the debt that they have on their balance sheet. And as a business, you can have the lowest cost of production, but you can still be insolvent if you have too much debt on your balance sheet. And this is kind of the problem with the Diamondback Energy and Pioneer Natural Resources, that they need to kind of grow into justifying the asset valuations that they have in terms of what their equity reflects. And that's why they probably will continue going down even if oil price stabilizes down here. So I would say industries to look at right now: energy, that includes oil and gas, or E&Ps, exploration and production. Focus on the production, forget the exploration. Number two, related industries like midstream companies. You would obviously want to be looking more at something like a CNX Midstream than an Antero Midstream, because Antero Resources, which is the main client of Antero Midstream, is going belly up, and that will mean that Antero Midstream will have no clients to use with its pipelines, and any other pipeline provider that's connected to that is in trouble too. CNX Midstream has other aspects that are good or bad, depending on how you see it. I think they are going to cut their distribution at some point in the future for some capex. I remember one of the analysts was asking them to, just do a 1-year holiday on the distribution, and the management said no. and therefore I would assume that at some point in the future they're going to have a dividend distribution cut. And I would hope that since the CEO of CNX Midstream and CNX Resources is now the same guy, I would hope that they would take the opportunity after the distribution cut to wipe down the equity value of that company and then just acquire it on the cheap and bring it back into CNX Resources and combine the two companies. That was what I would kind of hope to see. But you have to think about these kind of scenarios. So, you know, not everything that seems good is good, and not everything that seems bad is bad. And then shipping. Shipping is very important right now. Russia has, of course, with Nord Stream 2 being in trouble with these sanctions, so Gazprom is going to have some delays on getting their pipeline, their second pipeline to Germany, I think it is, online. And that means that tankers are experiencing right now a surge again in demand. I saw that the VLCC spot rates have surged yesterday, or, well, not yesterday, but on the 10th of March, they rose to from 45,000 to 93,000, and yesterday for the 11th of March, they rose to 193,000. So basically, shipping is very strong right now because the energy price, the oil price, has collapsed. If you think of it this way, there are three factors that really play into shipping. You have, number one, the cost of oil. If we're just looking at the tankers, I'm talking now specifically about the tankers for energy. Oil price is low, that's a positive. Number two, the IMO 2020 compliant fuel price the premium has shrunk significantly. It's down. It was like a $200 premium to what's it called, high sulfur fuel oil, and now it's only like 90% premium. Then number three, I probably should go back into number one. So number one, the oil price, that means demand for oil is up. Number three, oil price is down, means OPEX is down too, so their operational costs have declined too. And what's happened now, obviously, is that since China has now come back online and that they're back in, looking to import oil and gas again, I guess, and they're going to try and stock up because prices are historically low, and why not take advantage of that? They probably are going to start importing more oil, and you can see that in terms of the shipping rates. If you have oil prices at when they were at like 55, let's say, it didn't make sense to pay 190k. Oops, that's an X. 190k for VLCC made no sense. But if you're talking about $33 oil, maybe you could even think about $400,000 for a VLCC. And this is like obviously a short-term pop to these levels because now they all want to get the cheap oil, and that could like phase out, and the shipping sector is very strong at this point in time, unlike the Dow Jones and the oil price. So that's kind of where it's at for this point in time. Then number two, it's probably going to take a year or so for this one to come out next, is industrial commodities, copper as an example, and that will also branch out into, of course, copper mining and bulk shipping. Now what will happen, of course, is as we do seem that we're going into recession, already down 1.36% again, another 300 points or so on the Dow. We're going to see low copper prices, which will, get the bulk shippers experiencing the same as the oil tankers are experiencing right now with the energy the energy prices. So bulk shipping rates will start increasing rapidly. Iron ore will also come down in price eventually, probably to the 60 or to the $50 a ton range, and that will start, spurring demand for bulk shipping. But first, of course, you need to wait for these industrial commodities to come down. So that's kind of like some ideas for investing as we collapse with the Dow Jones just falling apart, already down 360 points again. There's no end in sight to this. It's just going to collapse. It's very sad, but this is the world we are living in. A bubble, and it's popping right in front of our eyes. Copper price and oil prices are low and in the toilet. And there are some industries, of course, that will benefit from this. Oil tankers and eventually bulk shippers. And then, of course, a couple of years down the line, 2-3 years down the line, we will, of course, see oil and copper at much higher levels as production comes offline because of the low cost. And that will lead to, obviously, again, a boom. The boom that will come with the quantitative easing. That after the bust, quantitative easing will come back in and reflate all this nonsense. So I guess that's going to do it for this video. Just remember one thing: the waterfall of hope. That's what we're falling down. There's absolutely no reason to buy right now, even as the news is trying to confirm that this seems like it is a bottom. Don't believe it. The oil price collapse showed the exact same thing. Like I said, Iran news seemed like it was going to be war, and there was no war. Then OPEC was going to hold in and support the price, and then OPEC did a 180 and just did the exact opposite of what the news was telling investors to expect. So that is where we are at. The waterfall of hope. We're just falling down. There's no end in sight. And as long as you see news like emergency rate cuts over here, bailouts over here, ECB saying that policymakers need to do something, they're all playing the somebody's got to do something card, but nobody's doing anything. It basically comes down to what Jim Cramer said back in the 2007 credit market freeze or meltdown. He said that Bernanke has to call somebody, and they're all playing this somebody's got to call somebody card, but nobody has the phone number of anyone who can actually do something about this. The problem is, as mentioned, too much debt, and I know I'm repeating myself probably because I've been talking like for quite some time now. There's too much debt in the system. There's a lot of bankruptcies coming. There's overproduction in certain fields like the shale oil and gas sector is overinflated. It's got too much capacity that comes out of money being spent on projects that turned out not to be viable, especially not when you're just putting in money to produce more oil and gas, and you're hoping that you're going to come out with the lowest cost producer, or at least in somewhere in the middle where you can actually make money over the long term. And if you just go by the arithmetic, there's always going to be low cost and high cost producers, and somewhere in the middle is going to be the breaking point where some make the money and others don't make the money. And it doesn't matter whether, for oil, like for example, it doesn't matter if $33 is that point, or whether $25 is that point, or $40. It really doesn't matter. So yeah, that's going to do it for this video. So even though I have talked about some ideas and given this recommendation to oops, that didn't work out so well, this recommendation to do these 3 things, creating a watch list doesn't mean you have to invest. But in general, of course, I don't give investment advice or recommendations for individual investments. I just say that you need to make your own decision, and I think at this point in time the only way of caution is these 2 points for sure. So yeah, if you like the content, don't forget to subscribe, leave comments, questions, opinions in the comments section, and have a good day.